Can a neural network designed to identify faces or objects effectively predict the price of JPMorgan stock? This paper explores whether convolutional architectures can decipher the chaotic noise of the S&P 500 better than traditional time series models. Predicting the stock market is notoriously difficult because financial data is incredibly noisy and volatile. Historically, analysts and algorithms have relied on manually engineered indicators, like moving averages, to make sense of the chaos. While researchers often use recurrent architectures, like the LSTM for time series data, the authors argue these can struggle with training stability. Instead, they propose using a CNN, typically used for image recognition, to automatically detect spatial patterns within the numerical noise. To make this work, the model treats historical trading data not as a simple list, but as a one-dimensional image. They construct a matrix with 10 distinct channels, consisting of the raw and adjusted open, high, low, close, and volume data points. Before feeding the network, the data undergoes a critical pipeline, starting with cleaning to remove low-information columns. Crucially, they normalize all values to a 0 to 1 range, ensuring that massive trading volume numbers do not overpower the smaller price figures. The core architecture is a 10-layer network featuring 8 convolutional layers designed to capture both short-term and long-term trends. To maintain stability during training, they utilize batch normalization and leaky ReLU activation functions throughout the depth of the model. For the learning process, the researchers employ cross-entropy loss, coupled with a softmax classifier, which penalizes the model when it is confidently wrong. Through experimentation, they determined that the ADAM optimizer, with a batch size between 200 and 250, yielded the best results. With the architecture defined, let's examine how this image-based approach performed on actual market data. The results were striking for certain assets, with the model achieving 91% accuracy for JPM stock, vastly outperforming a 69% baseline. Notably, the model successfully navigated complex events, like stock splits, without requiring manual adjustments to the input data. However, the approach is not a universal fix. The researchers found that hyperparameters do not transfer easily between stocks. For example, applying the JPM settings to MSFT resulted in poor performance, indicating that each stock requires specific tuning of learning rates and batch sizes. Looking ahead, the authors suggest creating hybrid models that combine the feature extraction of CNNs with the memory of LSTMs. They also plan to integrate large language models to process news sentiment, moving beyond pure technical analysis into fundamental analysis. To learn more, head to emergentmind.com.